And yes, good morning, good afternoon, good evening, wherever you listen to this webinar. I welcome you to today's Trade the Markets Profitably with Admiral Markets, the Open Range Breakout. My name is Klatt, and I have the honor today for the next 45 minutes, around 50 minutes, to present to you, in my case, in fact, one of the most profitable trading strategies I've got to know till this date, and I trade in the markets, one of the, in fact, yeah, most profitable ones. It's in fact not that I present to you the Holy Grail today. It is more a basic strategy which you can adopt to every market. And in fact, this is something we will do tonight. So in my case, tonight, by the way, because I'm here located in Berlin, Germany. So it's here 6 p.m. in the evening. But again, this is a worldwide webinar, which means it could be that someone is listening to this right now here somewhere. I say, well, let's say Bora Bora, and there we have 6 a.m. in the morning. And yes, before we start, again, we have to have a look here, first of all, at the risk disclaimer. And then I'll show you that the strategy I prepared here for this evening for the S&P 500 can be adopted also to the DAX, which has a special day today. But first of all, the risk disclaimer. So trading with financial instruments offered by Admiral Markets like CFDs, ETFs, stocks, they carry a high level of risk, which is not suitable for all investors due to their complex nature. And before entering into any agreement or transaction, please read the terms and conditions of the service from Admiral Markets. Consult a specialist if necessary to ensure that you understand the risk, risks involved in trading, and that investors should also study carefully the so-called KID, the key information documents, in order to understand the nature, risks, costs, potential gains and losses of margin products which are offered by Admiral Markets. If you do not have those key information documents, you can easily reach out to Admiral Markets, contact the support and get them there. And there are several reasons why Admiral Markets is considered to be one of the probably best brokers out there. In fact, they have by far, and probably from today onwards even more, a very, very, very competitive DAX offering, which with with a typical spread here of 0.8 points during the main trading hours, which means Xetra trading hours here, so 9 a.m. till 5:30 p.m. German time in this case. And there is also a special offering. Again. After let's first go through those slides here. First, the regulatory background. Admiral is regulated by the FCA, so you can double check it on their website. And you can also, again, Admiral Markets, you can contact Admiral here via mail or via their YouTube channel. But now let's have a look here, not at my Vita here, but at this 3-step intraday trading strategy, usually for the S&P 500. But first of all, let's have a look at the website from Admiral here, and let's have a look here at this special day today. So for us in Germany, that's in fact a special day because today is the DAX birthday. It was introduced in 1987. In 1988, that was yeah, in fact, a special day. And here you get the gift for the anniversary gift for the DAX, which birthday is it today, from Admiral. So you can see here that you can now trade until the end of campaign. So the whole month of July, starting from today, you can start trading today with Admiral here on a 0.5 spread in the DAX, which is then, I'm not sure, but probably I don't know any broker out there who has a more competitive offer in the DAX right now, and probably will never have. And so then it's not 0.8 points, which I just mentioned in the first slide, but it's 0.5. And I've taken this here as the reason why today I want to guide you through a trading strategy then for the DAX, which makes probably more sense than to look at the S&P 500, even though on Wednesday here, that is on the 4th of July, yeah, we would usually stress test the strategy. In fact, here we'll probably go through the strategy in more depth, probably have a look at some psychological things which come into play, why it's so important to have a clear predefined plan when trading in general, and why it's necessary to follow a clear, structured, well-structured plan in your trading. Because on Wednesday there is Independence Day, and Independence Day means that in the US markets are closed and there's no S&P trading taking place, in fact. So that's one reason why, in fact, we won't stress test the strategy then, which we have a look at today, even though the strategy itself, you can really adopt it to many other markets, and it's profitable on many other markets. That's one of the reasons why I like this strategy so much. And so we go through those 3 steps here. First of all, for the S&P 500, but then we'll follow with adaptations made at my end here for the DAX, and how you could adopt this strategy then to the DAX. In fact, my trading is sometimes it's very simple, and in fact it's very, very boring. What do I mean by that? Well, it means that I follow a clear plan, step by step, every day, all day, then I just follow this plan, and I just trade the markets that way. I know exactly what I have to do, when I have to do it, how the orders will be placed, and there's no real intervention or changes to this plan here. From time to time, that was something I mentioned at the beginning, from time to time, the basic strategy, I adopted from a discretionary perspective. That means, all in all, we know that profitability in trading arises from a so-called positive expected value. And positive expected value means that you try to, by the way, it makes definitely sense here to open the editor, to write this down. So the expected value comes down to this formula. It's the average gain. You multiply it with the hit rate, and then you subtract the average loss, and you multiply this with the loss rate. And this has to be bigger. This has to be bigger 0. And if it's bigger 0, that means you're profitable in your trading. That's in fact all. And so when I'm talking about the basic strategy, it means that my target is to know, I trade the strategy which I know which is profitable. That means it has already a positive expected value. Let's say 10 cents per every euro you risk. So what does this mean? That means nothing more than, if you say the EV, hypothetically, let's say it's 10 cents. That means that you make 0.10 cent euro per every euro you risk. So if you adopt this, let's say to let's say 10,000 euro account, and then you say you risk 1% risk per trade, which equals to 100 euros. That means nothing more than you can, based on the formula above, you can theoretically calculate what you can expect to make per trade. And it doesn't matter if it's a winning or losing trade. In fact, you make this if you can stabilize those parameters around the so-called average gain and the average loss. If you, by the way, have the ratio of those two, you get the so-called payoff ratio. And then if you can also stabilize the hit rate, you usually or naturally will also stabilize the loss rate, because if you have a hit rate of 50%, that means 50% of your trades are not winners, they are losers. If you can stabilize those parameters here, that means that you're making, and it doesn't matter, again, if you're winning or losing, you make 10 cents per every euro. Your risk here in your trading, that means that you make 10 euros per trade gain. Okay, so this is, sure, it's before commissions, it's before spreads. You consider that's, by the way, one of the reasons why you should definitely consider this offer here of 0.5 spread, because this can dramatically increase your overall profitability in your trading again. But let's assume here it's we already have those parameters included here, commission, spread, and all this. So we make 10 euros per trade. That means it's an intraday trading strategy. That means you have around 200, let's say 250 trading days, but let's take out those 50 days because you're on vacation, whatever. So it's 200 trading days. that means you make 10 euros on 200 trades. That means you make 2,000 euros a gain, which equals, if you're trading a 10,000 euro account, which equals 20% per annum you're making. So, and this is exactly why the expected value and the theory behind this is crucial to understand when it comes to profitability in your trading. And so what is my target in my trading is, in fact, something very simple. I look at the markets, I analyze them, I try to spot certain behavioral patterns the markets have, patterns which, for example, consists of a certain range which the market forms here. And if the market breaks out, then the likelihood that the market, let's say, will make a run of 1.5 to 2 of the initial risk here is higher in the long run, then it's probably that the market will come down and not reach this target, respectively the trade being stopped out. Let's say this is the pattern. In fact, this is the basic idea behind the open range setup. And if you have such a basic strategy and you know about the expected value, in case your target could be to optimize this expected value. In fact, this is exactly what I do in my trading. So in fact, when I enter the market, I'm going long or going short, I'm not looking for potential targets I could hit or something like this. I mean, sure, if you're in the markets for quite a while, as I am, so something like 10 years and more than that, and you're trading, sure, you have a certain level of experience you gain over time, and sure, you get a feeling of how extended a market looks and whether it makes probably sense to now run your stop or trail your stop more aggressively after the market. But all this, in fact, is with one target, to somehow try to increase this number here, let's say by 1 cent or by 2 cents. You may now say, well, does it really make such a big difference? In fact, it does. I mean, just imagine you have a positive expected value of 10 cents per trade, and then you're capable, thanks to your market experience, to a more aggressive exit management. You just found out to be more profitable, whatever. You can increase this number by, let's say, 2 cents, by 20%. That means your overall profitability rises by another 20% from, in our case, then, those 2,000 euros to 2,400 euros. Which is in fact a big difference, because I mean everyone will agree that having 4% more and at the end of the year in the trading account is something to definitely look after in your trading. And so what do I want to say here? Why do I talk and just to wait for the definition of the open range setup? It's very simple, because I want to make sure that you understand that it's not about you just duplicate the strategy, even though you could, in fact, because again, the basic strategy is profitable already, and we will show this with some backtest results here. Nevertheless, what I do in my trading is I use those strategies as a basic strategy, and then I try to increase, to optimize the overall positive expected value this strategy already has. Okay, so again, it's today, it's the anniversary of the DAX, so we'll have to look here at the S&P 500, but those 3-4 steps we'll go through here will be adopted to the DAX then accordingly. So first of all, what do we do? And that's, again, if you know those 3 steps, again, trading becomes very, very boring, in fact, even though it's still fascinating because you still do not know whether the trade will be a winner or a loser at the end of the day. So what you do in the first step is you define the open range between 3:30 to 4:15 p.m. Central European time. In this case, this is German time. So how you define the open range? In this case, I've already prepared here the Admiral chart. This is, by the way, the tool we will use then in our live trading, the mini terminal. And with these red thin lines, those thin lines you can see here. So what you do is you mark the low of this range and you mark the high of this range. So in fact, you look at those 3 candles, because it's a 50-minute chart. You look at the candle here at 3:30 German time. This is the next candle, 3:45, and this is the next. It's 4 p.m. German time here. If this candle closes, it's 6:15 here. I'm sorry, 4:15. Sure, 4:15, because it's a 50-minute candle. Okay, and what we look after again is 3:30 till 4:15. And then you look, where's the high, where's the low, and you can define this range. You can define it here with those two lines, and then you do the following. Now you have to trade in direction of the predefined advantage. Here on a 50-minute time frame. You already guessed it, and you guessed right. It's the blue line here. This is the exponential moving average 10 on a 50-minute time frame. And it's very, very simple, in fact. If we trade above it, we only go long and trade breakouts in direction of this identified advantage, meaning on the upside. And if it trades below, we only trade the short side. This is something which will become very, very interesting for the DAX, which I want to have a look at here with an adopted intraday trading strategy based on the Open Range Breakout. Because here, in fact, we had no trade today, even though we broke out on the upside. And you will surely see why this is, because the adaptation here also consists of the second step, which is about to identify an advantage. And probably you guessed it right already, because you say, okay, probably we traded below this exponential moving average in the considered time frame, but broke out on the upside, so we had no trade. And this is in fact the case, something you will see in a few seconds then. And now what we do is we trade the break of the open range in direction of the identified advantage, and we put the stop above, respectively below, the high-low of the range, and that's it. You obviously can see where we take our profit. This is something probably I have to rather sooner or later include this here. But again, this is probably not necessary to do right here, because again, this is the basic strategy, and it is about how do I get into the market. And I already know that my stop is placed here above, respectively below the high-low of the range. And so now it is about how to define a potential target on the upside. I can already say it's no rocket science, let's call it. We say in my case, 9:50 p.m. German time. It's 10 minutes before the markets close. We take out the trade. That's it. Probably let me just include this probably here. 1 second. So it's take profit. Take out the trade at 9:50 p.m. CET. So this is only true if the market did not hit the stop level then till this moment. So let me just do it that way. Okay, that's great. So there we go. So this is how we define our take profit here in this case. So we do not have a take profit intraday at all. We just let the market run, hopefully in our direction, strongly trending in one direction, closing in the region around the daily highs, respectively daily lows, depending on whether we're long or short. And then we take out the trade manually / automatically, in fact, because we do not look at where the market is trading, but we just take out the trade at this time, and that's it. So that's the step where this is the definition of the open range and how to trade it here for the S&P 500. Again, the example, let's use today's chart, is obviously we are trading above the blue line. We are breaking out on the upside, so we're going long when the market breaks. Here in this case today above 2,710.9, so we are long here, and now see the market unfortunately moving against us and heading for the stop loss. Obviously, so far we're not stopped out. Probably the market will turn around, definitely something which could happen here, but this is how the setup in fact looks for today, and we have no chance to intervene in any way. It's only that we say we wait till the first 45 minutes of trading after Wall Street opened at 3:30 p.m. German time. We wait for the first 45 minutes. We have a high and low of a range between 3:30 and 4:15, and then we just place our buy stop, respectively our sell stop, depending on whether we are trading the long or the short side, obviously depending on whether we are trading above or below this blue line. and then we just enter the market and take out the trade if it's stopped out, or at 950 we just close the position by just taking out the position, then just closing it. It doesn't really matter where it trades right at this moment. So this is how it worked today. Let's have a look here then again at the does this work? No, it doesn't. Okay. So these are already the steps we want to follow here for the DAX, but let me first of all show you here this example on how this looks, in fact, if the market moves strongly in your direction. So you can see here, when looking at the chart, you can see those thin lines. They are not red in this case, they are black, but nevertheless, we're trading above the line. This blue line in this case, we're breaking out on the upside. This is the high and the low between 3:30 to 4:15 p.m. Central European time. And we go long once the market breaks out here on the upside. And then we take out the trade here at 2,724.25 at 9:50 p.m. Central European time. The same would be true, by the way, if we trade within this range. So if the market does not move in one or the other direction and presents itself really unspectacular, if volatile, and we are nevertheless are not getting stopped out, and we're trading somewhere in between this range, we just take out the trade here too. So it doesn't really matter where we trade, we just take it out if we're not stopped out, and then we move on to the next trade, which will take place the next day. So now let's have a, oh, sorry, that was the wrong one. Let's have a look here now, because of the anniversary of the DAX, at my adaptations I run for the DAX in this case. So in fact, the DAX is special because here, for example, I'm not trading the 50-minute time frame, but I'm looking at the 5-minute time frame. Some of you might be surprised to hear that now and wonder why. In fact, you could also do an adaptation for the S&P for a 5-minute time frame. The setup would still be profitable. Nevertheless, the thing is that I adopted it for the 5-minute time frame, or I'm trading the 5-minute time frame because I started out as a 5-minute intraday day trader, in fact. So my mentor back then, the same is true, by the way, why I chose the S&P 500. Some of you might wonder, because usually it's common that many traders prefer the Dow Jones, especially when it comes to CFDs, because it's more volatile. And in case of, for example, Admiral Markets here, it's also very competitive offering with 1-point spread, which is compared to other brokers really, really good. And nevertheless, the reason I trade the S&P 500 is because I never learned to trade a different market. Respectively, that was the first market I traded, and I never changed this behavior because my mentor back then traded the S&P 500, and he traded the DAX on a 5-minute time frame, and I never changed this behavior. I probably have more strategies than I had back then. And also for other time frames, for example, an hourly chart. I trade on the FX markets on a also breakout strategy. Nevertheless, the thing is that in case of the DAX, for example, it's a 5-minute time frame, and that's just it here. And this is mainly due to the fact that I started out as a 5-minute trader here. So we go through these 3 steps again now for the DAX, and we have to define obviously our open range, which we have to define between, in this case, 8 a.m. till 9:05 a.m. Central European time. Now, the interesting thing is that many of you, especially those who are more experienced probably and are trading the markets for quite a while, know where the parallels are here between the DAX and the open range of the DAX and the open range of the S&P 500. This open range obviously is defined around the time when the main volume pours into the market here, and markets are getting more volatile. This is the opening hours, the market opening hours, in fact. So when looking at the DAX here, we see that it starts at 8 and closes at 10, even though I already said it at the beginning of this webinar. The main trading hours are between 9 to 5:30, 9 a.m. till 5:30 p.m. German time. This is when Xetra is open. This is when the spot market is trading and when the most volume is turned in the DAX. And this is also, by the way, the reason why within this time frame you can offer such a really competitive and very attractive offering of 0.5 point spread here, because you do not have a problem as a liquidity provider to get liquidity during these trading hours. And this is something very, very important. And so in case of the DAX here, in fact, nevertheless, there's a time frame between 8 till 9 a.m. which is a little special, let's say, because, and this is something I have to probably write down here. It's an information which is, by the way, not that true for the S&P strategy, where we just wait for the first 45 minutes of trading. But in case of the DAX, and now let's write it down, etc. We have the main trading hours, as I said, between 9 till 5:30 p.m., while the so-called future DAX, which is traded at the Eurex, is open from 8 till 22. And there you can already see that within this time frame, from 8 to 9, there are obviously, it's not only that the volume there is lower than you usually see it during the main trade, as you see it during the main trading hours, but it's also the case that usually within this time span between 8 to 9 a.m., usually you have very many professional traders in the market around this time. And the market starts to build a range with a high and a low, from which a breakout then, when it occurs here, usually is giving the direction for the trend of the day, the intraday trend, where it develops here. So now you can see that obviously I'm nevertheless using a slightly different time here with 9:05. Why do I use 05 in this case? This has to do with the fact, as I already said it, the main volume pours into the market at 9 a.m. And what you see is usually not only the volume usually significantly rising, but it's also that the market starts to act very volatile and very aggressive in one or the other direction. And to avoid any stop-ins happening during this time span, and which are most of the time purely coincidentally, let's say, I just said that I'm waiting the first 5 minutes of trading here and enter the market then if the market breaks out in one or the other direction. By the way, not resulting in any problems around the profitability, the overall profitability of the approach here, in fact. So this is how we define the open range and why we define the open range as we do. So we start at 8 because of the reason, because of the fact that the FTX starting trading there at the Eurex, and then we wait another 5 minutes after Xetra came in here, and wait until the market has stopped acting very violently in one or the other direction, resulting out of the fact that the main volume pours into the market here. So then also here on a 5-minute time frame, we have to identify an advantage. In this case, we identify the advantage based on the 5-minute exponential moving average 50. It's in fact very interesting because now some of you might say, wait a second, if we look at the 50-minute time frame, you could multiply this here by 3 and then just divide this 50 here by 3 and have an exponential moving average on a 50-minute time frame. I haven't changed it, checked it, by the way, so I don't know, but probably this adaptation makes sense for some of you who say, I prefer trading the DAX on a 50-minute time frame. In this case, you would test then on a 50-minute DAX, the 50-minute DAX here, and run the back test, let's say, with an exponential moving average of, let's say, 15, and then see if it's still profitable if you use an EMA exponential moving average 13, so -2, and +2, 17, for example, to see whether it also performs well within the neighborhood here. If it does, this is also probably an approach which is then long-term profitable, in this case for the DAX. And then this, well, it's simple, as I already put it here for the S&P. If we trade above this exponential moving average 50, we trade the DAX long. If we trade below, we trade it short. That's just it. And then we trade, again, the break of the open range in direction of the identified advantage. If we trade the break, we place the stop above, respectively, below the high and low of the range. And also here, the trade, in fact, which I want to present to you, the back test, is where the exit of the trade is slightly different. In fact, this is also something I have to write down here. We are working profit. It's 2 to 1. I think this, yeah, I think this gets the job done here at this point. 1 second. So what do I mean by that? It's very simple. Let's assume you have a stop of, let's say, 20 points, or let's say 25 points. What does a take profit of 2 to 1 means? It means that you place the stop 50 points from your entry point. Then, if the stop is 25 points away. So this is what I mean by 2 to 1. That means risk reward of 1 to 2 in this case, the other way around. And let me just give you an example of how this didn't play out today, because I already mentioned it. We had a very interesting development here. As you can see, this is the open range. Again, you start at 8, and then you look at the candles within the time span of 9 a.m. German time. So this is the 9 a.m. candle here in this case. And as you can see, here's the high of this range. Here's the low of this range. And now we are breaking out of this range on the upside. What is the main reason for this? There's currently, and this is one of the reasons why I have trouble with the DAX, to be honest, in current market, under current market conditions. It's very political driven currently because of this, this game around Chancellor Merkel and her correlation partner, one of her correlation partners from the Christian social party, the CSU, this is the Bavarian party, and they were against the migration policy of Merkel right from the start, and were very, very aggressive also in their rhetoric here, and against the approach which Merkel used. And now we are probably about to see a breakup of this coalition happening. And if this really happens, this is something which could drive the DAX sharply lower. And in fact, when we started today, we opened 150 points below the closing price of Friday. And the main reason was that yesterday in the evening, the chief of this party, of this Bavarian party, his name is Seehofer. He said he was offering to resign. He's not just the chief of this party, but it's also that he is the current, I don't know the English word for Innenminister, by the way. So it's the chancellor of the, no, the minister of the, nice, interesting. Let me just Google this here. It's the secretary. Okay, yeah, interesting. So I thought that interior is probably what it means or what it could be, but somehow it doesn't make sense. But it obviously is the secretary of the interior. Okay, yeah, okay. So this is his position, and so currently this is exactly what's driving the DAX lower, and what drove the DAX higher than he was that he said, okay, he gives Merkel another 3-day deadline here and waits with his resignation, and that was something which caused this breakout then here on the upside out of this range in this case. So that was the reason why this green candle occurred. Usually it's very difficult to say what caused a certain move in the market, especially in such a short period of time. But nevertheless, there's definitely something. There was a reason. There was a clear reason why this happened. So from a causality perspective here, and that was the news that Seehofer just said. Okay, I wait another 3 days. Let's see how things develop here. Now, nevertheless, we didn't have any trade here. The reason is simple, because we broke out of the open range. Yes, on the upside, that's true. Nevertheless, we traded obviously below this blue line, which is the exponential moving average 50 in this case. So this said, we had no trade. What some systems usually do now is the following. They could say, okay, then let's place a limit order here. In this case, a buy limit order, and wait till the market trades back to this level again. But the market never traded back to this level, and so there was no trade today. Last week, I presented a trade to you that was also based on the open range. That was here, this sharp decline. It's 1 week ago. In fact, oh, by the way, sorry. I think I have to. I just saw that probably you have to move here to this day. That was last week on Monday. It's 1 week ago. There were some very interesting and strong trending markets, and this is, for example, something where you can already see if you're not working with a risk reward of 1 to 2 here in this case, for example, where such a strong intraday trend then could make you a very attractive trade, and you could make some good points here on this way down, and in fact pay for all those times when this approach does not work. This is something to remember and keep in mind when deciding to trade such a breakout strategy. The hit rate, in case of what I just presented for the S&P, and let's come back to this presentation here. I presented it for the S&P. The hit rate here is 47%, while the hit rate for this DAX strategy in this case, for the time span I checked it here, was around 42%. So around 45% is usual, let's say. So probably we had a time span within which the hit rate wasn't that good. Nevertheless, it was still profitable thanks to the payout. In this case, we used which was 2 to 1. So first of all, unfortunately, I forgot to write down that this is the result of the backtest of the S&P strategy. So which I presented on a 50-minute time frame, and there you can also see here, this is the exponential moving average 10 we used in this strategy. Yeah, we can see that the number of trades we just backtested here was 1,347. Again, here you can see the win rate is 47%, and then you have the average profit and the average loss, which comes, in fact, if you divide those two numbers with each other, then you have a ratio of 1.31 to 1, and giving you an overall expected value of 8 cents per every euro you risk. So which means that obviously the overall approach is, as you can see here, profitable. Some of you might really wonder, can it be that such a simple and rough approach with only following these 3 steps, respectively 4 in this case, because we have to take out the trade here, consider this to be probably one extra step, but can this really be profitable? And the backtest result shows yes, it can. And same is true for the DAX here. By the way, probably a short story I have to add here. So the story behind this backtest result is that I had a presentation with another profitable trading who has a very quantitative approach in this trading. And so we were discussing of how to present the content optimally at the event we were invited to. And I said, I have some trouble because the host of this event wanted me to use his platform. Respectively, he wanted me to use also not just the charting, but also the data he provided. The unfortunate thing was that there was not enough data to really run a solid backtest here. And so I asked him what we can do about this, and he said, no problem, I have data, and I will run it in a neutral environment, in this case in Excel. And by the way, it was an event which was an online event here. And so this day, when we had this presentation together, he had some internet connection problems here, had prepared it on his computer and hadn't sent it over to me. And so I had to take a screenshot here just to anticipate that probably his internet connection will break up again. This is exactly what happened 10 seconds later, but nevertheless, I was capable of taking over. And because I really, enjoyed this, talking about this anecdote over and over again, I just used this snapshot here from there, which nevertheless shows exactly what we want to show, that this approach is profitable. But now, I've also run a backtest, something which is more what you're probably more used to, let's say. This is the Emitter trader backtest result. And as you can see, by the way, it's only a short time span. I checked it. There was also a problem with a time span and available data, I have to say here, on a 5-minute time frame. Usually it takes an enormous amount of time to really run such a backtest. And some brokers really cut the available data here a little, and you can nevertheless get it, but you have to pay sometimes quite enormous sums to get this. And nevertheless, I think it still shows, also because the numbers are quite good in this and not impressive, but still in the range what you should expect to get from such a, in fact, very simple trading approach. So here we are not looking at over 1,000 trades, but only at 225. The interesting thing now is that here is the hit rate, as you can see here. So by the way, it's in German, so some of you probably have some trouble to understand this, but nevertheless, I think if you had a look at such backtest results here with the MetaTrader, I think you can easily follow my words here. So here's the 42% hit rate. These are the hit rate, the winning trades, and then you have on the other side you have 58% losing trades in this, or percent losing trades here, which is 131 from 225. And then even more interesting, we have here the average gain per trade. It's 157 euros. While on the other hand here, we have the average loss with 99.70, which is even more interesting, I think, because this is exactly the result you should expect when trading a 10,000 euro account with 1% risk. So if you lose, in fact, you usually should expect the market really to stop you out, and then you lost, in this case, 1%, which is 100 euros. This is probably, nevertheless, not really true. And why is that? Well, the thing is that I said, well, sure, the stop out occurs in this case here. This occurs if the market is breaking the range on one side and is then reversing and just falling to new daily lows, respectively rising to new daily highs. Yes, but the thing is, if the market does not make it, that's probably something why the take profit of 2 to 1 is a little irritating now. That's something I have to keep in mind, and that's why I have to adapt the slide a little. Just imagine the following. You're now stopped into a trade, the market moves in your direction, but it does not hit the take profit level. What do you do then? If the market trades back into the trading range, usually you have to have a point where you then take out the trade. And by the way, this is exactly the same time you take out the trade. As I mentioned for the S&P, it's 10 minutes before, in our case, the future DAX then closes. This is 10 minutes before 10 German time, 22 here. So 9:52. So this is where you take out the trade. And nevertheless, as you can see here, and this is the interesting thing now, when you are stopped into the trade, you can be sure that the market, well, moves in your direction or you get stopped out. This is very interesting here, that this is usually what this result will already show you here in this moment. Okay, so now you can fill in those numbers into our formula for the expected value. What we want to do, you take the average, so it's expected value, EV. You take the average gain, which is 157 euros. You multiply this with 0.42. Oh, by the way, that doesn't make sense. Don't work with such numbers, but we want to work with neutral numbers, in this case, so the payoff ratio, which means we have 157, and we divide this number here then by 99.70. In our case, let's round it down and come down as 1.5721 then. And then we subtract 1 multiplied with 0.58. And then you can see, by the way, I have to calculate this, but it should be 6.6. Very interesting. And now you can see what I'm talking about. Oh, sorry, 6.6. And you subtract 5.8. And what do you get? You get nearly the exact same result for this time span here, with a slightly lower hit rate than, nevertheless, of 0.08 cents. The same result we got for the S&P. So usually, what does this mean? What does it tell us? Based on my personal experience, usually you should expect with this approach to have an expected value somewhere in the range between 0.05 to 0.1 cent per euro you risk. This is usually where I come out. Usually you come out in times when everything goes as expected, let's call it, and as usual, then usually you come out at 7 to 8 cents per euro you risk with this approach. Obviously, if you can, in this case for the DAX here, for example, increase the hit rate a little or reduce the loss rate, however you might do this based on market experience, let's say, you should then expect something in the range of 8 cents per euro you risk here as an expected value in this case. And Yeah, so in fact, that's it from my end. Regarding this strategy, again, will be difficult to stress test it here on Wednesday based on the fact that it's Independence Day. Nevertheless, we'll probably use this as a starting point to give some further ideas on how this could affect our overall psychology in trading. Probably some of you have trouble to really stay with a strategy, respectively, let a winning trade run, for example. And the concept which was introduced from Daniel Kahneman and Amos Tversky in their behavioral economics theory. Both are Nobel Prize winners and all this, because losing hurts twice as much as winning is giving you joy, a joyful feeling here in this case. And this is one of the reasons why it's sometimes really troublesome to let losing to let winning trades run, but also very troublesome to take a loss then, which is crucial to overall profitability in trading. And yeah, so why this is a good starting point for trading psychology. Let's have a look at this then on Wednesday. I'll give you some insights on this, and yeah, I just hope that that you can or that you have a lot of fun with this strategy here for the DAX. And again, check out the offer from Admiral. Currently 0.5 point spreads during the main trading hours. It's, I think, one of the, if not the most competitive offering right now. Around the DAX anniversary, now you have the strategy, and then you can obviously and hopefully profit from it in the markets. Test the strategy. That's something I'd recommend. Test it in a demo environment. Make yourself used to the strategy. If you have any questions, shoot them over. Send them over to Admiral. Probably they will forward them to me. Join me the next time here in a webinar. Ask the questions there. I'd really happy to answer your questions. And that's it from my end. So all the best. Have a nice evening, and have a good day. See you.